In this video, I will show you 5 KPIs for successful investing, successful stock picking. Sometimes you only want to focus on these 5 things and you will make a lot of money. You will find great businesses. My name is Christophe Nour and this is exactly what I do. I focus on these 5 things. I've been investing in the stock market for almost a decade now and I have achieved a performance of 25% per year. My performance is completely public, by the way. You can check my website. And let's start. Let's just start. You know what? 5 KPIs. 5 KPIs. The KPIs we want to focus on are about efficiency, growth, valuation, because this is what we want when we invest in businesses. So let's start with the first one. The first KPI, and a really important one is the ROIC, the return on invested capital. What is the ROIC? What does it mean? And what are the numbers that are important here? Return on invested capital measures efficiency inside the business. If you reinvest $1, how many dollars do you have after 1 year, 2 years, 3 years? So if you have a ROIC of 20%, you can reinvest $1 and get back $1.2. And you want the ROIC to be as high as possible. Obviously, I would be suspicious of ROIC above 100%. That's an accounting trick. But you basically want the ROIC to be above 10-15%. Okay? This is a metric that I often preach on my YouTube channel. It's very important, and because in the very, very long term, like multi-year horizon, multi-decade horizon, companies and stocks will follow the ROIC. So if you invest in a company with a low ROIC, like 6%, it doesn't matter if you buy cheap. In the very long run, the stock performance will be 6% per year. In the contrary, if you buy a stock that is expensive, but they have a ROIC of 20%, after many years, I'm not talking about 2 years or 3 years now, I'm talking about maybe a decade. After a decade, even if you bought it at an expensive price, you will have a performance of 20%. At the end of the day, this is what matters. But you can combine these two. I mean, you can combine a cheap valuation and a high ROIC. That happens. Sometimes you have strange things happening in the market. I mean, we've seen this with meta platforms, with Facebook in 2022. Cheap valuation, high ROIC, and since the crash, it's a 5x, 6x. So wonderful here. You want the ROIC to be high. The higher, the better. The second metric I want you to focus on is the free cash flow yield. The free cash flow yield is the reverse of the price to free cash flow. So we often talk on YouTube about the PE ratio. Very well. You want the PE ratio to be below 30. That's a good indicator to avoid overvaluation. The price to free cash flow is very similar. So you want the price to free cash flow to be below 30. That means you want the free cash flow yield to be as high as possible. You want this yield to be above 3%. That means you are willing to pay a price to free cash flow of 30 or less. The lower, the better. So that means, as a reverse formula, the free cash flow yield should be high. If you can find a free cash flow yield of 10%, that's good. That means 10% of the company is in free cash flow. I mean, they generate 10% of free cash flow, 10% of their market cap every year, which is really good. So now you can start to combine these two KPIs, ROIC and free cash flow. If you use a screener, you can do this. I personally use a screener FinChat. There is a link in the description in case you want to use it. You will have a discount. You can combine these two metrics to find extremely good investment ideas. The third metric, the third KPI to focus on is the margin expansion. Margin expansion. Regardless of the margins, right? In the business, you have several margins: gross margins, EBIT margins, net margins, free cash flow margins. I'm just talking about long-term global margins going up. You want margin expansion. And I won't give you some numbers here because the margins change depending on the industries. if you sell hardware, software, if you manage some lands, if you do some real estate, if you are a distributor, if you are Walmart, Costco, you will have low margins. So it will depend. What I want you to focus on is a margin that improves over time. Look at the past 10 years. Look at the 10-year track record of a company and see if the gross margin is going up. And if it's not going up, look at EBIT margin, operating margin, and see if it is going up. Normally, for great businesses, you will find margins going up. If the margins are decreasing and have been decreasing for the past 10 years, that's not a good sign. That's not a good sign at all, I would say. So focus on businesses that become more and more efficient. And the same way you want some appreciation of the margins, some expansion of the margins, you also want some expansion of the ROIC. If you look at the past 10 years, look at the ROIC chart, and you want it to move up, basically, to increase more efficiency, more margins, more money. That's a way of showing that you have a moat, a competitive advantage. And if a business can sustain high margins, high ROIC for a long period of time, it shows that they have an amazing moat, a very wide moat, and they are way better than competition. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Okay, now another KPI for you is the debt level. The debt level is a very good indicator to show if a company is well managed or not. Just look at the debt and compare the debt, total debt, long-term debt, short-term debt, everything on the balance sheet. Compare it with the market cap. See if it's a big amount of the market cap. If the debt is equivalent of the market cap, it means 100% of the market cap is in debt. I mean, that's not a good sign. That's not a good sign at all. You can compare this to the market cap, okay? And you can compare the debt level to the free cash flow generation. In other words, companies will generate revenue, earnings, free cash flow every year. Imagine a company that generates $1 billion of free cash flow per year. Okay. And now they have $3 billion of debt. That means that in 3 years of free cash flow generation, they can pay off their debt, which is good, which is nice. Now compare the same situation, same free cash flow generation, $1 billion per year, and now they have $12 billion of debt. I mean, 12 years to repay your debt, that's a long time. That's a long time. And basically, the best situation is to invest in companies that don't have a lot of debt. If they have no debt, that's even better. Most of the time, that's a good sign. You have the situation where debt is useful, that's sometimes the case, but you need extremely good management. Most times, it's better to avoid debt, especially now with the 5% interest rates. I mean, in the past decade, money was basically free with low interest rates, but now, as I assume you know, interest rates are way higher. Debt is more costly, so you want to avoid debt at all cost. So you can put this again on your screener. Avoid debt. Avoid debt, minimal debt compared to the market cap or the free cash flow. And the last thing I want to focus on in this video is the revenue growth. Revenue growth is that's one of the most important things to check for a business. If a business is growing or not. That's it. You want to avoid businesses that have a decreasing revenue. You want to avoid businesses that are reducing their market share, getting smaller, less efficient. That's not very good. You want to focus on companies that grow. How do you grow? That's very simple. Either that's price, either that's volume. You sell more stuff, or you price up, or your total addressable market grows. I mean, if you have, I don't know, for example, e-commerce, that's an industry that grows massively. Let me increase my face here. E-commerce is an industry that grows massively, right? So you have more sellers, more buyers. Even if the market share is stable, the revenue will grow. So if you are focused on a growing industry, growing amount of clients, customers, more volume, more pricing, there are a lot of ways to increase the revenue. So in terms of revenue growth, you can check companies that have grown their revenue more than, let's say, 8%, 8% over the past 10 years. This is a good indicator of if a company has grown or not. So that's it, guys. 5 KPIs to focus on. Just put this on a screener and you will find some very interesting opportunities in the market. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a video, a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.